Mutual funds work by pooling money together from many investors. That money then gets used to purchase stocks, bonds, and other securities. Because mutual funds invest in a collection of companies, they offer instant diversification, thus lower risk to investors. Advantages of mutual fund. Mutual funds offer diversification or access to a wider variety of investments than an individual investor could afford to buy. There are economies of scale in investing with a group. Monthly contributions help the investor's assets grow. Mutual funds help investors diversify unsystematic risks by investing in a diversified portfolio of stocks across different sectors. While individual stocks have both unsystematic and systematic risks, mutual funds are only subject to systematic risk or market risk. Mutual funds offer diversification or access to a wider variety of investments than an individual investor could afford to buy. Funds are more liquid because they tend to be less volatile. A mutual fund provides diversification through exposure to a multitude of stocks. The reason that owning shares in a mutual fund is recommended over owning a single stock is that an individual stock carries more risk than a mutual fund. This type of risk is known as unsystematic risk. The biggest advantage of investing in mutual funds is that they are managed by qualified and professional experts backed by investment research team. Structure of mutual fund. Sponsor. The sponsor sets up the MF by investing the required capital and getting the MF registered with the regulatory body, Securities and Exchange Board of India, SEBI. Trustee. The trustee is appointed by the sponsor. Trustees are responsible for safeguarding the investor's interest. AMC Asset Management Company. The AMC is appointed by the sponsor to launch and manage schemes of the MF. The AMC undertake marketing of schemes through distributors and directly to investors. AMC manages the scheme's investments. Intermediaries in mutual fund. Distributors. Distributors are authorized to market MF schemes to investors. The AMC ties up with distributors to market its schemes. Transfer agents. Registrar or transfer agents are the trusts or institutions that register and maintain detailed records of the transactions of investors for the convenience of mutual fund houses. Custodian. Custodian is responsible for holding and safeguarding the securities owned within a mutual fund. Types of mutual funds by structure: open-ended funds. These are funds in which units are open for purchase or redemption through the year. All purchases/redemption of these fund units are done at prevailing NAVs. Basically, these funds will allow investors to invest as long as they want. There are no limits on how much can be invested in the fund. They also tend to be actively managed, which means that there is a fund manager who picks the places where investments will be made. These funds also charge a fee which can be higher than passively managed funds because of the active management. They are an ideal investment for those who want investment along with liquidity because they are not bound to any specific maturity periods. Which means that investors can withdraw their funds at any time they want, thus giving them the liquidity they need. Close-ended funds. These are funds in which units can be purchased only during the initial offer period. Units can be redeemed at a specified maturity date. To provide for liquidity, these schemes are often listed for trade on a stock exchange. Unlike open-ended mutual funds, once the units or stocks are bought, They can't be sold back to the MF, instead they need to be sold through the stock market at the prevailing price of the shares. Interval funds. These are funds that have the features of open-ended and close-ended funds in that they are open for repurchase of shares at different intervals during the fund tenure. The fund management company offers to repurchase units from existing unit holders during these intervals. If unit holders wish to, they can offload shares in favor of the fund. Types of mutual fund by asset class. By asset class, where investment is done, equity funds. These are funds that invest in equity stocks/shares of companies. These are considered high-risk funds but also tend to provide high returns. Equity funds can include specialty funds like infrastructure, fast-moving consumer goods, and banking, to name a few. They are linked to the markets and tend to. Debt funds. These are funds that invest in debt instruments, for example, company debentures, government bonds, and other fixed income assets. They are considered safe investments and provide fixed returns. These funds do not deduct tax at source, so if the earning from the investment is more than Rs. 10,000, then the investor is liable to pay the tax on it himself. Money market funds. These are funds that invest in liquid instruments, for example, T-bills, CPS, etc. They are considered safe investments for those looking to park surplus funds for immediate but moderate returns. Money markets are also referred to as cash markets and come with risks in terms of interest risk, reinvestment risk, and credit risks. Balanced or hybrid funds. These are funds that invest in a mix of asset classes. Risk and returns are balanced out this way. In some cases, the proportion of equity is higher than debt, while in others it is the other way round. An example of a hybrid fund would be Franklin India Balanced Fund (DPG), because in this fund, 65% to 80% of the investment is made in equities and the remaining is invested in the debt market. Mutual funds are a good way to invest in markets for a beginner, as he takes low risk but better returns on his investment. Next video we will talk about investment products and its pros and cons. Don't forget to like, share and subscribe the channel.